Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Feeling the pressure, sell America, see stocks, bonds, and the dollar sell off in tandem. Futures attempt to rebound this morning. Finding a scapegoat, President Trump continues to blast Fed Chair Powell's policy. And as analyst warnings stack up and sales slump, Tesla report earnings before the bell. So we do attempt to rebound. After maybe what was the quietest sell-off, again, that toxic mix of stocks down, yields up, and a dollar weaker. We're up by more than 1% across the major indices this morning. Relief for the NASDAQ after slipping into yet again a bear market yesterday, down 21% from the highs. The thing that continues to lead us lower, you can see gold at the bottom of your screen at one point hitting 3,500 for the first time on record. It's hit 22 all-time highs so far this year. When it comes to the bond market, it was a sharp steepening of the yield curve yesterday. The 2s, 10s, and 230 slope saw their steepest levels since January of 2020. We're a little changed this morning, but slightly higher on the front end by about 3 basis points, 378 there, 441 for your 10-year yield, and the dollar at its weakest level since 2023. Let's look at some stocks underneath the surface with your stocks to watch this morning. Here is Bloomberg's Joe Easton. Good morning, Joe. Great to have you back.
Morning, Danny. So Boeing in focus today is the company potentially going to be selling its Jeppesen navigation unit to Thoma Bravo, the private equity company. Now, Bloomberg has previously reported that this business could be worth around $8 billion, so it isn't a small unit by any means, but Boeing shares only up around 0.5% in the pre-market. Then here in Europe, Novo Nordisk absolutely slammed at the open of trading in Copenhagen following that data from Eli Lilly, which showed their weight loss drug, which is a pill, saw users lose around 7% of their body weight in 40 weeks, and that is a huge competition concern for Novo. The Danes had a nice 5-day break for Easter, but that stock getting hit as they come back following the holiday. And then finally, keep an eye on solar stocks. We are seeing some small moves higher in some of those shares as Trump slams 3,500% tariffs on some of the goods produced out in Asia. I had to read that headline twice when I saw that. And as usual, this is all on the Before the Bell opening wrap on the terminal, written by yours truly today, so have a read of that one.
I'm sorry, Joe, did you say that the Danes get 5 days for Easter?
5 days, yeah, absolutely fantastic. Right. I think I might be moving to Copenhagen.
I was going to say, you and I will have a word with the bosses and put in our notice to see if we can be moved out there. Joe, thank you so much. Bloomberg's Joe Easton with the stocks to watch. And we have a great hour coming up for you. We're going to be catching up very shortly with Max Kettner of HSBC, and later in the hour, Lori Calvasina of RBC Capital Markets. Now, President Trump has been doubling down, putting the pressure on Fed Chair Jay Powell, posting on Truth Social yesterday, quote, with these costs trending so nicely downward, just what I predicted they would do. There can almost be no inflation, but there can be a slowing of the economy unless Mr. Too Late, a major loser, lowers interest rates, now, of course, referring to Fed Chair Jay Powell. And equities selling off yesterday in reaction to the pressure. Joining us now is Max Kettner, Chief Multi-Asset Strategist at HSBC. Max, really great to see you this morning. Look, it is a market that had been dictated on the different machinations of trade policy. How do you even begin to price this in? Not necessarily even Trump trying to fire Jay Powell, but just continuing to talk about it.
Yeah, good morning. I think what it does is it really leaves sort of the position indicators, the sentiment indicators, really a bit in flux and a bit in question, actually, at the moment, because when we look at our framework at the moment, actually, the last 3 weeks, it's been sending some buyer signals, but we haven't really followed that. It's been really the first time in, I would say, years that we've not followed our own sentiment and positioning indicators and have argued against any sort of technically driven, at least technically driven rebound, because precisely like you say, you just don't know, right? You don't know whether the next day there's going to be some more volatility coming, something more unexpected. The truth of the matter, I think, is for us, it doesn't really matter what happens next with the tariffs, what happens, what kind of rate is being slammed on country A or country B, how the negotiations will go with Japan or with Canada or the EU. What matters most and what really mattered most in the last few weeks for us is that kind of uncertainty, is the level of elevated uncertainty. Is that truly going to go away? What is the potential that will completely dissipate? And that, I think, continues to be utterly low, and that keeps really risk assets pretty vulnerable, I think, at this point.
But Max, I mean, we're talking about the next 4 years then, aren't we? If this is the feature of Trump's policy, is this uncertainty, what are we talking about for equities, not just this year, but for the entirety of Trump's term?
No, I don't think so. I mean, number one, we've got the midterms next year, so let's see how those will go. I don't know, but let's see how the midterms will go. Maybe that will change things, for example, number one. Number two, I think there will come some point also in terms of fundamentals and in terms of what is being priced in, where things really will look like, okay, now there's enough pessimism in the price. We're just not at that level yet, right? Everything's good at price. Everything's for sale at some certain price. It's just not that the price is quite right at this level. When we look, for example, at a couple of our fundamental indicators and we compare them with cyclical against defensive equity performance globally at the moment, there is still almost a double-digit gap between those indicators, those fundamentals, and what cyclicals against defensives are pricing. So clearly, there is still too much hope priced into cyclicals. I think once that comes down, once you see a bit more pessimism priced in there, then to us, the price is a bit more right, and then that's really time to go back in.
And what does that look like, Max, to have an appropriate level of pessimism priced in?
Yeah, I think so. The level that we're looking for between the fundamental indicators that we track, sort of the forecast revision, top-down forecast revision and revision momentum, when we plot that against cyclicals, against defensives, at the moment we've got an almost 9 percentage point gap between those two. So once that is closed, right, so once we see perhaps cyclicals underperforming another sort of 8-9 percentage points, I think that's enough pessimism. When we've got, for example, in perhaps already in May, some evidence of the April data, the hard data disappointing. Again, that would be a sign of really, enough weakness already being in the economy and being already in the data. Because so far, let's remember, the narrative, the widespread narrative is really, don't worry, it's all the soft, it's all the survey data, it's just a slowdown, it's not a recession. I think once we do see some evidence that the hard data is indeed slowing, again, that is, I think, enough of a sign of, okay, it's not just a slowdown, we've got to price in more in. Once that a bit more pain is in, I think that's the right price to go back in then.
And Max, you're very much talking about the fundamentals of the economy here, but I wonder if there's a degree, and you even just look at the move higher in yields, that it's been led by real rates, not necessarily break-evens, that the real concern is about less credible policy, means that kind of the huge privilege that the U.S. has in order to run these twin deficits goes away, and the foreign appetite for buying U.S. assets goes away with it. Should there be a concern less about where the economy goes and that sort of flow and that sort of structural shift in how we view American assets?
Yeah, I think we are seeing that to some degree already, right? When we look at the dollar, actually, it is mostly a dollar move. Look at things like euro yen or even euro Swissy, that they are not moving nearly as far or are actually flat over the last 2-3 weeks relative to the dollar. So it is largely a dollar move. But again, I think once we see particularly also position indicators, sentiment indicators, a bit too stretched on the dollar side, I think that will also then at least give us a technical rebound in some of the US assets, particularly then also in the dollar, but also in US equities. I think we're going to get, I think, to the point in the next 2-3 months where it's going to get really consensus to be rest of world overweight over the US, and where you'll probably start to see some sort of rebound. Because I totally appreciate, yes, we've got this policy uncertainty, we've got this political uncertainty, but let's remember, why do we buy the US? We buy the US but because the return on equity gap is now 4 times as high compared to the rest of the world than it was 15 years ago. We don't necessarily only buy it because, it's the Republicans or the Democrats in power. No, we buy it because of the earnings power, because of the margin superiority. And I don't think that really is going to go entirely away.
Well, to that point, Max, we're getting into the thick of earnings season. What are you looking out for? Because it's been very uneven as to what companies say about what their future will be and whether they're actually willing to give a forecast or even willing to give just one forecast.
Yeah, I think that's precisely actually what we're looking for. What we are looking for not only is on the top-down side, the first sort of hard data disappointing, but also from the bottom-up side, from the corporate earnings, really corporates telling us either, look, we cannot hold the full-year guidance, we need to cut full-year guidance, and or pulling guidance overall. And that is precisely what we're seeing at the moment, right? We are seeing more and more companies saying, look, we are unable to give you guidance, or they give you some sort of widespread fan charts where you're saying, well, if it's a recession, it's this. If it's not a recession, it's that. So, I think it's this kind of elevated level of uncertainty where really investors then at the end of the earnings season in 2-3 weeks will say, look, well, what do I do with this? With that level of uncertainty, cyclicals will have to take another beating. Once you've got that, I think then, again, it's time to go back in.
Hey, Max, just quickly before you go. So on a day like today where you do see a rebound and you're calling for no technical rebound is going to be happening, do you want to sell into those moments? Is that what you should be doing?
100%. 100%. I think moments like today, but also the last sort of hour and a half yesterday, they do tell us there is very little panic so far. In fact, when we look at our indicators, real money positioning, long-only sentiment is still pretty elevated, right? So far, it's really been systematic selling. It's been hedge fund selling. Long-onlys, on aggregate, at least on our measures, are still overweight in equities. They've trimmed in credit, both in IG and high-yield credit, but in equities, still overweight. So to me, I think perhaps even retail buying, long-only, still this buying the dip behavior is in there. As long as we've got that, I think any kind of rips, any kind of or any evidence where really people are buying the dip, you want to use that to trim exposure even further.
Yeah, I go back to my favorite earnings headline of yesterday, of last week, Schwab saying that our clients want to buy the dip and want to buy equities, but are asking for help. Max, thank you so much. HSBC's Max Kettner, always so wonderful and insightful to have you on. Let's get you some other top stories now that are trending on the terminal this morning. Joe Easton mentioned this. The U.S. is imposing tariffs of over 3,500% on solar imports from Cambodia, Vietnam, Malaysia, and Thailand. A years-long investigation found solar manufacturers from those countries were unfairly benefiting from government subsidies that helped them to sell to the U.S. at rates lower than their costs. Harvard has escalated its showdown with the Trump administration. It sued several U.S. agencies and top officials for freezing billions of dollars in federal funding. Lawyers argue that the government unlawfully suspended the funding after it refused to comply with unconstitutional demands to overhaul hiring policies and diversity programs. And Nomura has agreed to buy Macquarie's U.S. and European public asset management business for $1.8 billion. It's Nomura's most significant overseas acquisition since it bought Lehman Brothers in 2008. The all-cash deal allows Nomura to scoop up about $180 billion in client assets. All of this according to a company statement. Coming up, U.S. retailers seek tariff relief. We're going to have more on President Trump's meeting with executives from Walmart, Home Depot, and Target. That's coming up next. Stay tuned to your brief. You're watching Bloomberg Brief. I'm Danny Berger in New York. President Trump met with major retailers at the White House on Monday. The executives were seeking tariff reliefs, Target among them putting out this statement. We had a productive meeting with President Trump and our retail peers to discuss the path forward on trade and remain committed to delivering value for American consumers. Joining us for more on this is Bloomberg's Brendan Murray. He heads global trade coverage for us. So we had Walmart, Home Depot, Lowe's, Target, among those included in this meeting with Trump. What do we know, what happened, and whether there was any progress made?
Yeah, so these companies, these retailers are coming to the White House with basically two big problems. The first is on the supply side. With so many countries facing tariff threats from the White House, they're going to have a hard time to continue to import in the quantities that they need to import and still keep their costs low. On the demand side, they're looking at consumer sentiment, business sentiment, and seeing those numbers go down with all the uncertainty that's around there. So these companies would be asking the president to go at a slower pace. Everything all at once is causing a lot of disruption, both on the supply side and the demand side for them. As far as what they're going to get, we'll have to wait and see. The president has been pretty adamant that these tariffs, are working, that they're driving countries to the negotiating table, and that inflation isn't a problem as a result. So it'll be interesting to see if that tone changes, that view out of the White House changes after he's heard from from these big retailers, Target, Home Depot, and a few others.
Well, elsewhere, Trump was posting on Truth Social yesterday saying tariffs are going well, everybody wants to negotiate. But Brendan, at this point, we have no agreement with Japan, nothing with Mexico, nothing really to show. Is there any movement anywhere that we've seen with country negotiations away from these specific companies?
We've seen several countries line up. We had J.D. Vance in India this week. They talked about how things went very well with those discussions. We have South Korea coming to Washington later this week. There are other countries like Thailand that say they want to make deals too. So it's one thing to say you want to make a deal. It's another to sit down and actually do it. It takes a long time. There are a lot of details. There are a lot of lawyers sitting around the room. And so it depends on what you mean by deal as when you ask how quickly they're going to come about. But you can pretty much bet that this is going to take a long time. It's not going to take days or weeks. These kinds of commercial arrangements have a lot of fine print to them, and they don't get done overnight.
Yeah, fair enough. I mean, the Trump administration had said we'd get 90 deals in 90 days. Of course, as you said, J.D. Vance in India. We are expecting a speech from him from Jaipur later in the hour. Brendan, thank you so much for joining. A lot to keep track of. There is the vice president there meeting with the prime minister. Thank you so much, Brendan Murray from our trade team. Coming up on the show, we're going to take a look at what else is making headlines around the world. We're also going to preview Tesla's earnings out. Those come before the bell. This is Bloomberg. This is your Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at what is on the front pages this morning. First up, coming on the Wall Street Journal, they're leading with the Trump rout taking historic dimensions. I know some people might be angry about this, but their headline does include the Dow headed for the worst April since the Great Depression. The index shed almost 1,000 points on Monday, which me just saying that might also make some people upset. Anyway, the Dow is doing things. Next up, the Financial Times writing about gold. This is their lead, hitting 3,500 for the first time. The precious metal has risen over 30% this year. It's benefited from a rush to haven assets as President Trump rattles markets with tariffs and that sustained attack on Fed Chair Powell, that adding the extra leg higher. Finally, the front page of the New York Times leads with the final days of Pope Francis. The late Pope had seemed intent on returning to pastoral duties and emphasized the themes that defined his papacy, such as defending migrants and people on the margins of society. So later this evening, Tesla will be kicking off the big tech and auto earnings. The reports after the bell. Shares of the automaker, they are up slightly, up 0.6% in the pre-market trade ahead of its first quarter numbers later today, but it fell yesterday. The company faces questions about multiple things, about its sales volumes, about autonomous driving, tariffs, and of course, CEO Elon Musk's ongoing role at the White House. Joining us is Bloomberg's Craig Trudell, who leads our global autos coverage. Craig, great to see you. What are you going to be looking out for in the earnings today?
I think Musk really has a sort of tall task on hand today, because he's going to have to sort of really do his darndest to have, the bright, shiny objects to sort of distract from the numbers. Because, when you look at what's expected revenue-wise, earnings per share, the consensus has just dropped like a stone on these counts. The expectations are really depressed, and I think there's a real concern too about just the second quarter as well. How much can we expect Tesla to grow volumes when all it has really to offer is a refreshed Model Y, and the Cybertruck is really letting folks down. The Model the Model 3 refresh did not pan out particularly well. And, the rest of the lineup is quite dated. So, on top of the issues with Musk and the concerns about, what he's doing to the brand and what he's doing in Washington, just real strategic issues with the company and when the company is going to have reinforcements in terms of fresh product.
In terms of that fresh product, we had that Reuters story back on Friday, Craig, about a delay to an affordable model. How important is it for sales that Tesla bring a more affordable Y to the market?
I think, especially in a market like China, where, Tesla is really sort of, getting beat soundly by BYD. A lot of that market is much more competitive at lower price points where you see a lot more volume. And, Tesla can try to play the premium game. But the question, of course, is, what can they offer on top of what you can get for, say, a BYD or a Xiaomi, and, to sort of justify the additional price. And I think you're seeing real sort of strain in terms of Tesla's ability to keep its sales volumes up when you have so much more competition with, fresher product to work with. You also, I think, in the U.S. Have, much more to choose from than you did a few years ago. Tesla still has a sort of stranglehold on the EV segment, but, you also have consumers who aren't necessarily, going electric in droves, and some slowing down of the momentum, as the rest of the industry really, goes into that segment. So it's a segment that isn't growing like it used to, and Tesla's no longer sort of got the claim on it that it used to have.
Yeah, it will be really interesting to also hear just the kind of questions that Musk gets in terms of, are you going to take a backseat in Doge and re-engage with Tesla? Craig, thank you so much for your help, for your coverage. I'm sure we're going to catch up tomorrow to do a postmortem of those earnings. Craig Trudell there covering the latest with Tesla. Again, those results coming after the bell. Coming up, RBC's Lori Calvasina says recession pricing could drag the S&P as low as 4,200. She'll join us coming up soon. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Feeling the pressure, Sell America sees stocks, bonds, and the dollar sell off in tandem. Futures attempt a rebound this morning. Finding a scapegoat, President Trump continues to blast Fed Chair Powell's policy. And as analyst warnings stack up and sales slump, Tesla will report earnings after the bell. So your markets this morning, we do attempt to come back after what was a very quiet sell-off yesterday. Again, it was that toxic mix of stocks down, yields up, dollar weaker, but we're up more than 1% across the indices this morning. Your S&P 500 futures session up 1%. Welcome news for the NASDAQ 100, which has fallen 21% from its peak back in that bear market territory. By the way, gold at one point hitting 3,500 for the first time has hit 22 all-time highs so far this year. When it comes to yields, those also taking a breather, but still under pressure on the front end, though it was curve steepening for much of yesterday. 2s, 10s, and 2s, 30s. Slopes reaching their steepest level since January of 22. We are at 378 for your 2-year yield, 440 for your 10-year yield, with the dollar trading at the weakest level since 2023. Let's take a look at some stocks underneath the surface this morning. With that is Bloomberg's Joe Easton. Joe, good morning.
Hey, Danny. So we've got Boeing in our sights today as the company said to be close to selling its Jeppesen navigation unit. That could potentially be worth around $8 billion. And we're seeing that stock edging up, only very slightly though, up around 0.4% today. Then here in Europe, the big action has been in Novo Nordisk. The shares absolutely slammed as Denmark comes back from a 5-day holiday. We saw that stock dropping around 10% at the open of trading. That's after Eli Lilly's drug showed that patients lost around 7% of their body weight, causing some competition concerns. That is an oral pill rather than an injection, so there's only going to be one winner over which one that you would rather take. So that stock hit hard. Then we've got solar stocks also on the agenda as well. Trump slapping 3,500% tariffs on some solar imports from some Asian countries. I had to do a double take on that headline when I saw that, but it is 3,500 in terms of the tariffs. Boosting some stocks today, including First Solar, that one up around 7% at the open. But also, of course, we're looking ahead to those Tesla numbers coming up after the close of trading later today. Danny?
Yeah, Tesla down more than 40% year to date, so slightly higher this morning. Joe, thank you so much. Bloomberg's Joe Easton with some stock movers. RBC's Lori Calvasina has been weighing in on the potential for a further stock drawdown, writing this morning, quote, "We don't believe recession is a foregone conclusion, but have been pointing out that a tier 3 drawdown or recession pricing could reasonably expected to take the index down to the 4,200 to 4,500 range on an interim basis. For now, we stay stick with our 5,550 year-end 2025 S&P 500 price target. I'm pleased to say that Lori joins us now. She's head of U.S. equity strategy at RBC. So, Lori, we're not in recession pricing yet, but is there signal in just how fragile the market has been, even if we're not at those lows that you point out?
I think that's fair. And what's interesting is if you look at the AAII survey, we're at GFC lows, 2022 lows, 1991 recession lows. So, pretty awful kind of levels. And you tend to get stuck at those levels for a while. But institutional investor positioning, if you look at this weekly CFTC data, is maybe like third inning in terms of its deterioration. So there's been some de-risking, but not a plunge. And I think that's where you sort of capture the idea of fragility, that there is some, sort of downside in the market, even though on the one hand people feel awful. The position data is not really telling us that things are washed out yet.
Well, it's interesting you say that because we had a conversation with JP Morgan Private Bank yesterday. We're talking with Max Kettner this morning, and both kind of said this idea that people have been looking for opportunities to buy. And it's this buy the dip mentality that has been so ingrained in so many investors. Does something change that?
So, look, I think we have these 4 tiers of fear that we talk about. It's kind of like choose your own adventure as the news flow evolves.
Sounds like a horror movie, by the way, Lori.
A little bit. I will say I scared my husband, like when after I published this and walked him through it, which was not my intention, because, what I told him was this was sort of helping you understand when things get really bad, what levels you want to be thinking about buying at, right? Understanding what the downside levels are and kind of the natural kind of break points, I think is actually a comforting thought, maybe not to him, but was to me. But at any rate, we're sort of in this growth scare phase, which is similar to the 2010, 2011, 2015, 16, and 2018 drawdowns, where there was real fear of a recession or a big systemic crisis, but it did end up happening, right? It was a near miss. That's what we're pricing in right now. So the market is clinging to some hope that we can avoid a big crisis and that we can avoid a recession. Recession pricing, that's pretty easy, 27, 32 type percent. Big crisis tends to be you lose half the market value. And those are big, scary numbers. But I do think what we see over time is that even in those tier 4 periods, you do have longer term buying opportunities. And when we have sentiment that is so negative and so, kind of despair is the word that I keep coming up with, not panic. It doesn't feel like panic. But we do see that despair seeping in. And you have to remember that things do tend to turn around.
But in the past, when things have turned around, it's because you're getting a recession. You get the federal government stepping in with some loosening. You get QE to infinity, maybe. But do we need to think about this time as being different? Because we're talking about a reordering of global trade. We're talking about concerns of Fed independence. We're talking about actual structural shifts in the makeup of the American economy and markets. So could this time be different?
I think it could. And we've had some investors who have said, look back to that period of the early 2000s as maybe a potential template. And I always joke that this is a terrible one for any kind of modeling because we essentially had this triple bottom in the S&P in 01, 02, 03. The actual technical bottom was late 02. But it was a really longer term period of malaise. And we had sort of one thing after another, tech bubble implosion, recession, 9/11. We had, a lot of regulatory changes on Wall Street and questions about how investment research was being done. And then the Iraq War. I mean, there was all kinds of stuff that hit. And what you actually saw happen, though, was a significant rotation. Remember, value really started to outperform and had a big heyday that lasted into the financial crisis. I mean, that seems almost like anathema right now. There was once a period in time when growth stocks didn't lead.
Right.
And so to me, just that concept of rotation, we're seeing the U.S. kind of break down, people finally starting to take a look at other geographies. That's one echo that I do hear of that 01, 02, 03 time period.
Could it be value resurging too if we get leadership on the upside from somewhere?
I think it's, to me, the geographical question is more interesting. I sort of struggle with this growth value debate in the U.S. because on the one hand, we know the growth stocks are overheated. We know that those earnings growth expectations are decelerating. But for value to really work, you typically need a hot economy, and everything that seems to be hitting the market and pushing people out of the U.S. makes me think we're set up for kind of a sluggish economy for a while. So I'm really struggling with that, kind of idea of shifting into value. The geographical rotation makes more sense to me.
And we're getting some clues into what companies are thinking about and how they're thinking about. And for a lot of them, it feels like we have no idea. Here are various scenarios, or here's no scenario. We're not sure what's going to happen. I know you and your team are really, really good at looking through these various earnings statements. Are there any takeaways you've had so far? I know it's mostly been the banks so far.
Yeah, and to be honest, like last week was all about the banks, a little smattering of other stuff. Previous to that, we were actually reading conference transcripts in addition to earnings transcripts across the whole Russell 3000. And I think that idea of uncertainty, it's out there, right? I mean, you're having companies actually, I don't want to beat them up for saying they don't know. I think that's a valid response in here, and I applaud them for talking. I think that over the last couple weeks, we've finally gotten a lot more detail about what's going on and how they're thinking about their outlooks. And companies with tariff exposure are finally starting to really disclose some of those exposures, even though they may not be giving us, kind of the neat and tidy bow with, how it all bakes into guidance. I'm okay with that. The street can do that work to figure out the impact if they give us sort of the raw materials by which to go out and do the analysis. So that's my number one takeaway. So there's just more discussion, and that's really, really healthy in here. I think the other thing, I've noticed from the banks last week, and I sort of chuckled. I'm an equity research analyst, right? And I saw a couple of these big banks giving some shout outs to their equity research department. So I appreciate that on behalf of the sell side. But they were referring to this idea, and I think I've sort of settled into this as well, that we know that the adverse impacts are going to be there on growth and inflation, pushing growth down, pushing inflation up. Can we quite call a recession? It's not clear to me. People were so adamant we were going to have a recession back in 2022 and we didn't. Are we sort of setting up for something similar this time around? So I thought that they were sort of dialing down the temperature a little bit on the recession risk, which I think is appropriate at this point. I think the banks were really interesting in that they're like, look, we're indirectly impacted by tariffs, but we're going out and we're talking to all our customers and trying to figure out what's going on. One bank said, I forget how many companies they'd talked to, but they said nobody brought up layoffs. That's a really interesting, helpful data point. But what we were seeing is, some of these companies were saying, look, our companies are going to have to attack this through pricing. They are going to have to defend their margins. And we are seeing a pause on things like CapEx and M&A and activity in general. So it's a really, really messy situation. And I commend the banks that came out last week. I thought they gave a lot of really good, important detail.
I do wonder for the tech players, because one of the kind of booming animal spirits that we had to start the year in last year was this immense amount of CapEx coming out of big tech, that they're going to be spending on AI, that they need data centers. You have Wells Fargo reporting this morning that it looks like you might have Amazon pulling back on some of their data centers. Does that CapEx also bleed into the tech players? And what does that mean for what was a pillar of the bull market?
I think it's TBD. Look, I will say I feel like I haven't been reading all that much about AI lately, which is interesting. We have some transcript tracking charts, and I think the AI conversation is actually off peak, like still, up there, but has come down a bit.
Which, by the way, is crazy because it was all we were talking about not that long ago.
Right. I will tell you, every macro discussion, by the way, in last week's earnings calls was tariff, tariff, tariff. There was really no difference between the two, which made my job a little bit easier. But look, I do think that as companies are evaluating business decisions and investment decisions, everything is on the table, right? So we're going to have to keep an eye on that. This is more of a stale data point, but last year when we would sort of look through companies and their AI commentary, if you put aside the big tech players who were really experts and knew what they were doing, kind of everybody else, my team would sort of laugh because we felt like we were getting like all these, we called it small potatoes, like how many, text summaries and chatbots are companies going to talk about. Things for AI to really be impactful, it's got to progress beyond that. So is some of that going to be cut back on? We'll see. But it's something we can certainly keep an eye on.
I got to say, it feels like a different world than 4 months ago. Lori, so great to have you on. Thank you for helping us navigate it. It's always such a pleasure to have you on the show. That is Lori Calvasina of RBC Capital Markets. Okay, let's get you some other top stories that are trending on the terminal this morning. The U.S. is imposing tariffs of over 3,500% on solar imports from Cambodia, Vietnam, Malaysia, and Thailand. A year-long investigation found that solar manufacturers from the countries were unfairly benefiting from government subsidies that helped them sell to the U.S. at rates lower than their costs. And Nomura agreeing to buy Macquarie's U.S. and European public asset management business. The price tag on that is $1.8 billion. It's Nomura's most significant overseas acquisition since it bought Lehman Brothers in 2008. The all-cash deal will allow the bank to scoop up about $180 billion in client assets. All of that according to a company statement. Harvard is escalating its showdown with the Trump administration. It sued several U.S. agencies and top officials for freezing billions of dollars in federal funding. Lawyers argue that the government unlawfully suspended the funding after it refused to comply with unconstitutional demands to overhaul hiring policies and diversity programs. Coming up, Amazon eases off the AI spending, as we were just discussing, pausing some data center leases. We're going to have more on tech next. This is Bloomberg. It's your Bloomberg Brief. Danny Berger in New York here. Now, we are watching shares of NVIDIA and Amazon this morning, but they are rebounding after an ugly session for tech yesterday. There's also additional news that Amazon's web service business is pausing some data center leases according to Wells Fargo Securities. Amazon could potentially be following Microsoft and reassessing spending on AI and cloud computed related investments. For more on this, we are joined by Bloomberg's Tom McKenzie. Tom, it is the fear after this narrative led the bull market. Does it look like some of these big players are pulling back on AI data centers and CapEx?
This follows the story, doesn't it, from Microsoft around their pause around some data center leasing and build out, particularly in Europe. And now we have this note, as you say, from Wells Fargo Securities saying that they are seeing similar pauses now coming through from Amazon. And you're seeing as well investor sensitivity to this story. You're seeing some of the electrification stocks, some of the energy stocks in Europe falling on the back of this news. Even as you say, pre-market Amazon is up. So what we know at this point is, according to this analyst at Wells Fargo, they have paused some of these leases for data centers. We have heard from a senior vice president at Amazon from their global data center putting out a message on LinkedIn saying that actually they are seeing no fundamental change. And then, in fact, they continue to see strong demand, particularly for Gen AI and the data centers they provide to underscore that shift. The analysts say they're not sure whether this is a concern or whether this is just some of these hyperscalers basically adjusting to the environment. But what they do say in this note is that it does seem that these hyperscalers are becoming more discerning about their spend and about the leasing around some of these data centers. Also, as well, following the comments from Joe Tsai of Alibaba saying that he thinks there could be a bubble when it comes to the build out of data centers. Again, the vice president of the global data center at Amazon saying we are seeing no fundamental change. But it does raise the question, doesn't it, in an environment of DeepSeek, but also of those macro challenges around what could happen to labor markets and, of course, supply chains as a result of tariffs, what this means for the data center build out going forward and the sensitivity investors have to that exposure.
Tom, just while we're talking about the hyperscalers, on a very different note, we have Google facing off the DOJ in a trial starting yesterday over their search monopoly. Do we have any updates as to what the outcome of this might look like for the search giant?
Yeah, so this is a case that involves the judge who originally ruled in November of last year that Google had violated antitrust laws. This is about that judge looking now at potential remedies. And interestingly, the Department of Justice officials have come out and said that a forced sale of the Chrome browser should be part of that potential remedy. We also learnt that from January of this year, despite previously being found twice to have violated antitrust rules in similar cases, since January of this year, Alphabet have been paying Samsung to host their Gemini generative AI app on Samsung phones. We don't know how much, but we've heard that it's a considerable amount. These are monthly payments, apparently, to Samsung. This is something that Alphabet admitted, or at least mentioned, in the court case. We'll see what the outcome ultimately is, but previously you've had examples in terms of just how much Alphabet may be paying. They paid, for example, Samsung previously between 2020 and 2023 about $8 billion to host some of their apps on Samsung phones. So it could be a considerable amount. We know the DOJ continues to push for some kind of breakup. And again, forced sale of Chrome web browser is one remedy they are looking at. So this is a crucial case for Alphabet. And it's a crucial case, of course, for their competitors as well, the likes of Microsoft, but also OpenAI.
Okay, Tom, thank you very much. That is Bloomberg's Tom McKenzie. Now, elsewhere in politics, Vice President J.D. Vance is in India for a 4-day visit. You can see him there. He is speaking in Jaipur. He held trade talks with the Prime Minister Narendra Modi in New Delhi on Monday. The White House says that the U.S. has made significant progress towards a bilateral deal following those trade talks. We'll listen in to the vice president shortly, but first, let's bring in Bloomberg News desk editor Uni Krishnan for more. Uni, any sign of a deal yet between the U.S. and India?
Thanks and good morning. Yeah, I mean, I guess both sides, both White House and Prime Minister Narendra Modi's office have said that, they've made tremendous progress. Vice President J.D. Vance's visit underscores the level of commitment both sides have shown for a trade deal, and it is also to accelerate the progress of talks so that they meet the 90-day deadline. And it seems it's headed in a much positive direction.
So, by the way, J.D. Vance, again, speaking there in Jaipur after meeting with the Prime Minister Narendra Modi, at the moment just talking about it's the first visit to his wife's birthplace, so not talking about policy yet, just pleasantries. Uni, but they have 90 days to get deals done, and both sides are saying that there are more progress. There are complicated links between the two countries. What sort of timeline is realistic?
I mean, I guess given Vice President's visit, I guess we do foresee a deal happening pretty quickly. I mean, it's a different matter. It'll happen within the 90-day deadline, and I guess the Indian side has really warmed up to what Prime Minister Narendra Modi. During Prime Minister Narendra Modi's visit to the United States, where President Trump had reiterated that he wanted greater market access to farm products or for the U.S. farm products, and that seems to be definitely something that's going to happen under the trade deal, and also India's high prohibitive tariffs as far as electric vehicles were concerned. Several other aspects like high duties on heavy-duty motorcycles, especially Harley-Davidson, those have been addressed in the budget that was unveiled in India in February. So I presume we're really looking realistically towards a sort of a summit-level talk between President Trump and Prime Minister Modi in the immediate future for a trade deal.
Okay, Uni, thank you very much. Uni Krishnan in talking to us about J.D. Vance in Jaipur, who just says that Trump wants India to grow. Let's listen in to the vice president.
One that's constantly innovating, one that's helping people to form families, making it easier to build, invest, and trade together in pursuit of common goals. Now, I believe that our nations have much to offer one another, and that's why we come to you as partners looking to strengthen our relationship. Now, we're not here to preach that you do things any one particular way. Too often in the past, Washington approached Prime Minister Modi with an attitude of preachiness or even one of condescension. Prior administrations saw India as a source of low-cost labor on the one hand, even as they criticized the Prime Minister's government, arguably the most popular in the democratic world. And as I told Prime Minister Modi last night, he's got approval ratings that would make me jealous. But it wasn't just India. This attitude captured too much of our economic relationship with the rest of the world. So we shipped countless jobs overseas, and with them our capacity to make things, from furniture, appliances, and even weapons of war. We traded hard power for soft power, because with economic integration, we were told, would also come peace through sameness. Over time, we'd all assume the same sort of bland, secular, universal values, no matter where you lived. The world was flat, after all. That was the thesis, and that was what they told us. And when that thesis proved false, or at least incomplete, leaders in the West took it upon themselves to flatten it by any means necessary. But many people across the world, and I think your country counts among them, they did not want to be flattened. Many were proud of where they came from, their way of life, the kind of jobs they worked, and the kind of jobs their parents worked before them. And that very much includes people in my own country, the United States of America. Now, some of you are aware of my own background. I actually didn't plan to talk about my background at all until last night at dinner, while my children mostly behaved. We gave them an A- for behavior with the Prime Minister. The Prime Minister said, I have one request. I want you to talk a little bit about your background. And so I wanted to do that. For those of you who don't know anything about me, I wanted to talk about it. I come from, and I'm biased, the greatest state in the Union, the state of Ohio, a longtime manufacturing powerhouse in the United States of America. My home specifically is a place called Middletown. Now, it's not a massive city by any means. It's not Jaipur, but it's a decent-sized town and a place where people make things, which has been a point of pride in Middletown for generations. It's filled with families like my own, some of whom called us hillbillies, Americans who came down from the surrounding hills and mountains of West Virginia, Tennessee, and Kentucky to cities like Middletown in pursuit of the manufacturing jobs that were creating widespread prosperity for families all across America. They came to Middletown in search of what we call back home the American dream. In Middletown, my parents raised me. My grandparents raised me. They taught us to work hard. They taught me to study hard. And they taught me to love God and my country and always be good to your own. My granddad, who I called Papaw growing up, he typified that. Late into life, he worked as a steelmaker at the local mill. And I know India has a lot of those. Papaw's job gave him a good wage, stable hours, and a generous pension. All that allowed him to support not just him and my grandmother, but his own daughter and grandkids with him. Now, by the time I came around, money was awfully tight, but he worked hard to make a good living for all of us. Now, I know Papaw and Mamaw were grateful for the way of life their country made possible. Their generation bore witness to the formation of America's...
And that is the Vice President J.D. Vance speaking in India, talking about some of his background, relating it to that of India, but started out saying that the U.S. and President Trump wants a strong India, wants India to grow, and saying that it wouldn't lecture it with how to do so. So we'll keep an eye on any headlines coming from the vice president in India there as he tours the region. Let's get a quick check on markets as we head towards the end of the hour. You're looking at stocks attempting to rebound after a tough day yesterday of losses more than 2 1/3% for the S&P. Max Kettner of HSBC says he'd be selling into any strength like that of today. The Bloomberg Dollar Index also tries to rebound, trading around its weakest level since 2023 as yields take a breather. They have been moving higher. Again, that toxic mix of stocks, dollar, and yields down. All right, that is it for Bloomberg Brief. Surveillance coming up next. You're watching Bloomberg.